Okay, so
I
you're
can,
happy just to talk through this without
yeah, I can send you the deck, I guess.
Okay.
If there's a publicly accessible, like Google Slides or something, I can share for you.
Yeah, I gotta pull it up.
Okay, Kruger, so I send it to you. Can you take care of the screen share?
All right.
Let me see what I can do.
Okay, so I'll just keep this out for now. So hi guys, so welcome to the 5th AladdinDAO and BanklessDAO co-hosted research meeting. So, for people who join us for the first time, so AladdinDAO is an investment DAO focused on yield farming curations. We have a group of DeFi experts called Aladdin Boule Council, and we meet regularly to discuss the best farming ideas. We turn some of these ideas into protocols as well. And currently we have launched a concentrator and Collaborator, which are two products focused on curve and convex ecosystem. Concentrator helps farmers to enhance their CRV yields through compounding services, and Collaborator helps to maximize convex bribe rewards by providing non-liquidation leverage services. And for today's meeting, we're going to have one of our board members, Jeff Xie, and he is also a fund manager at Unitary Yield, and he is going to present DOPEX. And we'll also have Hako from the DOPEX community joining us as well. So I will pass it to Jeff and Hako.
Hello, hello. Pleased to meet you guys.
So please go ahead.
Hello, hello, hello. Yeah, just double check. Can you hear me well? Yeah, okay. Yeah, so once again, many thanks for having us. Many thanks for inviting us. So to intro ourselves, I'm Halke, and I am a member of the DOPEX team. So just to check, maybe we can just start with a very, very quick intro, because just to see if you guys have heard about DOPEX, about the on-chain options. If not, so let me just give you a super quick rundown. So DOPEX as a protocol is a protocol mainly on Arbitrum, right? Arbitrum is the L2 rollup of Ethereum. So if by any chance you would like to use the Ethereum native DeFi, or maybe you would like to become the Ethereum native builder, but L1 costs are high for you, well, come to Ethereum and you will see all the fun stuff that we have on Arbitrum. And now another thing is that, well, on Arbitrum, what we have managed to have is like the whole ecosystem evolved towards more like structured, more derivative products. The products that usually have some kind of like require a little bit faster latency, maybe more gas costly. And one of those products was DOPEX, and DOPEX is the abbreviation for Decentralized Options Exchange. So the protocol was founded by our founder, TZ, as well as our CTO. Our CTO is Witherblock. They had the idea to create the protocol a few years ago, and as DeFi has been evolving throughout the past few years, the idea has been also iterating as well. And I think it's safe to say that what we see now, right, is pretty much one of the like later iterations of the OPEX. And now to give like more, maybe to say a little bit more, is, well, how to say this, like, one maybe to like give you more history. Our founder was pretty much a very long-term options trader, and he was always thinking how to make sure you can trade options, you can utilize options on chain, right? Because we had many breakthroughs. We were able to trade the spot, to make swaps, to borrow, to lend on chain. But the derivatives market was quite limited. And even if you like think about the options now, then more or less a lot of like volume is still around the centralized venues, so like exchanges like Deribit. And one of the ideas was, well, how can we utilize blockchain? How we can utilize a lot of like architecture to try doing the same, but on chain. So hence, once we had L2 rollups, the OPEX was created, the OPEX was deployed.
Can someone mute themselves? Is that, I don't know if that's under answer.
I think that's answer. Can we hear?
So whoever is not presenting,
Yeah, can we mute answer?
Sorry about that. Continue.
Don't worry. That's all fine. That's all fine. So to continue, where we were at. So the OPEX was basically deployed, and the idea is if you come on chain with a product that may have a little bit of complexity, right? Because these are derivatives. I think we will just go into the details very, very soon what they are. The idea was, well, if you are going to create something for everyone, you need to allow users some level of abstraction so they are not overwhelmed. Give them a smooth kind of onboarding and make sure they understand what they do. So as the process of this constant iteration, also as a process of this constant simplification, what happened is the OPEX has created different products, and I think the most popular are the single staking option vaults, which are very, very simplified option products that allow users who are looking to be the option writers make sure that they are still tapping into all the cool stuff of DeFi, which means they can keep farming, single staking with their tokens, etc., etc. But at the same time, users can use the same tokens to write options. And this way, they can take more risk because they are writing options. But on the other hand, the same users may and can keep gathering premiums. So they may be paid by other users for the additional risk. Meanwhile, the users that are like more active traders, they can be the other side of the trade. So on one hand, we have like sellers, on the other we have buyers, and the buyers are paying premiums. These buyers are delivering funds to the DeFi users, and in exchange for like being able to trade options. So long story short, it's been a very, very long half a year, which so for many products to be created, iterated, changed. Like in general, it is a constant change. So whenever we deploy something, we see how it works, which way it works, what can be done better, what doesn't work. And I think it's still this process of constantly searching for answers and seeing what else can be done. So I think that's the overview. So in general, like if you are interested in derivatives, if you are interested in options, haven't had a chance to try Arbitrum yet, you are very welcome to come and just see how it all goes. Yeah, so I think I'm happy to pass it now to Jeff.
Cool. You guys can hear me okay?
Yes, we do. Yeah.
Yes.
All right, cool. Yeah, so I guess I've been trading options and futures for a while now, so I can go over some of the background, some kind of key important concepts to understand, and then I think it'd be useful to go through like a example trade setup or some of the historic trades that have played out, and how DeFi kind of plays into all of this. So, but yeah, fundamentally, to trade options, you have to have a basic understanding of what the Greeks are. So the major ones being delta, gamma, theta, and vega. There's a book reference I've cited that I recommend if you're a beginner. Just like the first six chapters is sufficient. So I'll kind of go into these more in detail, but essentially you have one primary factor that is the first derivative of price. And then gamma, which is the rate of change of price. Theta, which relates to how much premium you're paying, essentially the cost of insurance. And then vega is the volatility. And these are kind of the primary inputs into options pricing. And to give an example of like why you would use options is the payout structure is very different than using a levered perp, right? Levered perps, you have risk of liquidation, and it's a linear payout. So even though when you look at options kind of like expiration diagrams, like yes, it is linear, your mark-to-market P&L is actually nonlinear. And the reason that is because of your essentially gamma P&L. So in this first chart, I have like a June 2000 put on ETH, and essentially in early May, these were trading, pretty cheap, and I would guess they would have had like a 5 delta or something, and they had stayed there for over a month, and market makers are probably short. And what happens is it's like, okay, the market makers short this inventory, and they have some short futures to hedge that to maintain a delta neutral portfolio. But actually, as the underlying moves down rapidly, that delta goes from 5 to like 20 to 25, and then now it's in the money. So they have to dynamically hedge their profile, and it's like the option delta, premium from the vega is all kind of spiking in their face, and then they just have to aggressively sell more features to hedge that, which is why what you see in this kind of like in these linear payout diagrams is not the case. So in traditional finance, very popular to just sell wings, which is kind of like, yes, it is a good way to get yield most of the time, but you have to kind of know what other existential risks there are. And Alliance was like just an example from TradFi where I think they had like a client fund or something that was just always selling vol, right? And for the past 15-year bull market, they just kind of martingale that into making a ton of money until COVID hit, and then they lost it all. So we can scroll down to the next page here. So I just have a couple of links here. Okay. Realized versus implied volatility. Essentially the option premium comes from the spread from the realized. So it's like it's designed to capture the underlying movement. So there's like a path dependence. And it would make sense that there's a spread in paying for that uncertainty. So it's like the realized vol is what you can statistically calculate, but in the future there may be an event such as like the merge or the Federal Reserve changes something, and so this uncertainty needs to be priced into the option, leading to a realized versus implied vol spread. And there are unusual instances where implied vol might actually trade at a discount to realized vol, just due to structural effects. One interesting thing I like to look at is the volatility surface. If you can click into the Deribit link, I can just give a quick overview of how an options market maker would kind of look at their portfolio. Or if it's not
Yeah, no, just bear with me a sec. I have to share a different screen.
Yeah, all good.
You have that now?
Oh, okay. Yep, there we go. Yeah, so I like to go on this on the Deribit options data page, and so the primary things that like a professional options trader will look at is the vol overall. So you're just comparing, is vol expensive or cheap relative to historic, and then how much inventory risk do you have. And then secondly, you're going to be looking at the skew, which is like relative to at the money, are calls and puts expensive or not. So this is what's referred to as the volatility smile, to account for like these I guess idiosyncrasies of the market, where it's like in equities the skew is always to put, but it's like logically you would think, okay, as a log normal distribution, equities can only go to zero, so why wouldn't it be skewed to call? Well, it's because everybody has a innate fear that everything is going to go to zero. So, and there's a natural hedging demand for puts. So the premium is always to the put versus the call. And if you scroll down here, they have like a time series of both the at the money volatility as well as the skew, which is pretty interesting to look at.
Sorry, where should I go?
You can just stay on this options data page and then just scroll down, and then you to the time series of 1 hour at the money volatility, and yeah, this one. Yeah, so the at the money volatility, like we can see a spike that happened when Luna imploded, and that can be attributed to basically, well, first the market massively sold off, and then second, it's like there were probably some market makers that were short puts that, due to their automated risk models, they were basically just forced to buy back vol, at the money vol, whatever they could buy to hedge the portfolio. And you can see this kind of extreme movement in the risk reversal. So what this is like they've defined it as the 25 delta call minus put. So the fact that it's negative means that the put during that day was trading at a 20% vol premium to the to the call, which is very extreme. And like actually, yeah, if you're into market microstructure, these are kind of like forced liquidations where the derivatives are actually in control of the price action. And if you believe in mean reversion, which a vol trader pretty much does, you would be selling vol and buying skew on these kind of extremities, and then just closing out as it reverts back to the mean. So yeah, that's one way to see kind of the structure and the flow of the market. And we can go back to the memo here.
All right.
yeah, so but more on like these market flows right now. It's like the bulk of the volume is going to be on centralized exchanges like Deribit, as well as OTC. But there's also a decent amount of DeFi option vault activity. So inclusive of DopeX and then Theta Nuts, and there's like some other structured products, Ribbon, for example. But the majority of those are kind of vol sellers, right? It's like people have an underlying asset and they want yield on it. So naturally, you have to sell options to do that. And you'll notice that like when these auctions take place, the vol kind of dips. So on Fridays, when they do these option vault auctions, well, a market maker has to go bid these altcoin wings, and then they have to lay off the Vega somewhere. And the natural venue to do that is basically selling Deribit, Bitcoin, and Ethereum options. So that's an interesting little structural flow. And yeah, to anybody playing with options, you have to understand it is a truly zero-sum game, right? There has to be a counterparty to the payout of your option, and it helps a lot to understand who exactly you are trading against, right? So if you're a miner who has a guaranteed cost of production, then you kind of have no problem being short deltas. You could be selling calls, and not care that the market rallies in your face because you have a cost production, and you could also be buying puts to hedge it in case of a decline. So this is kind of like the natural demand for options, which makes it such a powerful tool in commodity products or whatever. And then you have speculators, so the hedge funds and whatnot that are buying or selling premium to express the view they want. And then you have these market neutral participants that are just trading the volume, the market makers. So yeah, I kind of give an example of when derivatives become a dominant force in price discovery. Another time this sometimes happens is like during expiration. So there's what they refer to as like either sticky strikes or this kind of large open interest. So what happens at expiration is that as you approach expiration, like the delta, the gamma asymptotically just approaches like infinity. The strike gets closest to the underlying. And if a market maker has not closed out the position, they are basically kind of just gamma scalping it. If they're short the strike, they want it to land on the strike, so they can realize their theta. And if they're long it, it's like they're paying a lot of theta, so they're kind of forced to try to capitalize on it. So any kind of volatility that they can capture, that they will, right? Otherwise, their options are going to zero. So you'll notice sometimes that there's like this magnet effect on the strikes with the most open interest, especially for like the big quarterly expirations. Sometimes you'll see that effect. So
Искать?
yeah, in trade. Oh, go ahead.
Где мне искать, Сергей?
Sorry, what was it?
Maybe just an open mic. Want to continue?
Oh, okay. All right. Yeah, so options, like when you make the trade, you kind of want to define what your thesis is, what you think your perceived edge is. So there's kind of like a asymmetric setup in two ways here. So it's like one is information and the second is the payout. Information is like when something fundamental comes to the market that an algorithmic market maker who is only looking at numbers and math doesn't understand. And the payout is like, if you're long an option, the most you can lose is the premium. Whereas the seller of an option can technically lose, not infinite, but like, their entire portfolio. So example of the informational asymmetry is like last summer when we went to EIP 1559, it's like people didn't really fully understand it, and Ethereum actually sold off going into the upgrade. So if you had just, understood that this affects, the base economics and starts burning some of the minor P&L, you could have decided to just, buy Ethereum calls or sell puts, something like that. And that's kind of like a purely quantitative options market maker. They don't even know what Ethereum is. They don't really care what it is. They don't know what EIP is. It's just a number for them to trade. They have mathematical vol models that tell them like this is value or it's not value. And that's the kind of thing that they won't immediately catch on. And where, a savvy options trader can go to the market and extract that. Another thing was like, it was pretty amusing last year when Raoul Pal started like shilling Ethereum. I think it was like March 10,000 calls and like 15,000 calls, which are kind of just so far-fetched. But, him and his billionaire listeners had so much conviction in that trade that I think those calls must have like 4 or 5x on speculative hype. And so it's like, even though there was very little chance of those calls expiring in the money, the options market makers that went short those had to take that mark-to-market loss, and it's like, so that's like an example of a Vega and flow trade. And of course, Arthur Hayes earlier this year, I think it was like April, started like doom posting, and he was saying like, yeah, the Fed is, they're going to tighten. It's going to be bad. And he started buying June puts. And essentially it was, as you can see in the chart before, like I think those puts basically 10 or 15x. So his thesis is like, okay, yeah, quantitative tightening is going to drastically affect risk assets, and things are going to sell off. And so you have this idea, and then how do you execute on this? How do you bring it, to a strategy? So then it's like, well, what are you trying to do here? Like, are you trying to maximize profits in USD terms or ETH terms or BTC terms, or do you simply want to hedge X% of your portfolio against a catastrophic drop? So in April, like, yeah, if BTC was trading at like 40K, and maybe you decided like yeah, I want to hedge half of my portfolio against a 20% drop. So you pull up the 20K puts in June, and see what they're priced at, and as a percentage of your portfolio, and decide like what's the risk reward on that. And then if it's not great, like, well, you can look into other structures. So it's like, I'm super bearish, but I also don't want to pay the outright theta. So you spread it off, right? You can buy the 20K put and then sell the 15K put to cover the theta. And yeah, like professional options traders will put on these structures to kind of like exactly express what their view is. So it's like, I'm short-term bearish, so I want some downside protection, but I also want the long-term upside going into like 2024 halving. So maybe I'll have like I want to own some longer dated calls, and then own downside puts in the near term or something like that. So yeah, there's like a bunch of ways to kind of express the exact view that you can't do with just futures. And then the other thing in DeFi, it's like supposing that rollups are, well, okay, I think eventually rollups are going to be fast enough that you can replicate like something reasonably close to Deribit, but that's not the most interesting part of DeFi, right? It is not to replicate a centralized exchange. What smart contracts do is automation. So it's like instead of having to hire these or attract market making firms, you're attracting a different set of users who they like. You're providing the service by providing a simplified product, and a way to express certain strategies without having to monitor an entire set of maturities, strikes, and Greeks and whatnot. So structured products fit right in. It's like these are like super big in digital finance. But essentially, when you package together your underlying with calls and puts, essentially you have these people that they want to own BTC, they want to own ETH, don't want to own yield on it. So it's a natural product market fit. The speed of rollups gets better. It makes sense that some of the active trading strategies can be done on chain as well. Hypothetically, you could be arbitraging DOPEX versus Deribit. I mean, right now maybe limited, but eventually it'll be. And then there's kind of these automatic automated strategies, which relate to Atlantic options, I think, where you can kind of determine certain actions that you want to take. Whereas, if you wanted to automate something on Deribit, it's like, well, you got to plug into the API, deposit collateral, and manage all this other stuff. So, I think that's where the DeFi options come in is automation and bringing power to the retail users. So that kind of sums up the notes I want to cover.
2022, it's not a COVID 2020. I know I'm in
其实做纠音很少，几乎没有什么人看到我同学中很多是这样。
Do we have an admin who could mint CADL123?
可是现在
Thank you.
30岁，我的表演会形成一定的模式，我是希望通过这个节目能够让大家看到，面对未知的困难，依然能够勇敢，依然能够披荆斩棘，能够让大家看到女性神父以后是什么样
And Charlene?
I'm not sure if I'm muting them for everyone or just myself, but hopefully that helps there.
Yeah, it's better now. So I guess if anybody has any questions or topics they want to talk about more.
Yeah, maybe what could be also interesting, right, is maybe we can also mention a little bit what may be interesting, like what could be interesting from the DeFi users' perspective, right? So for example, if someone is not a professional yet, but is already operating in DeFi, which is a pretty much very highly volatile environment, then I think even simple users are being exposed to many risks which they may or may not. It is especially kind of tricky, like whenever the market keeps going up, because if it goes up rapidly, then many users may not notice that actually their exposure to risk is very large. So even right as a regular DeFi user, you may be sometimes thinking, right, that you may or may not feel too confident with, for example, holding certain tokens or opening certain positions, because right, you think that it's like 80-90% chances that the market moves the way where you expect it moves, but there is a small chance it just nukes very hard. And even though this is very unlikely, right, to happen, it will more or less ruin you. So I think this is something we can like go back in time to April, where people were expecting, we can reach certain upside, certain downside, right? But if you were like a regular user, most likely maybe holding your ETH spot, you are more or less comfortable thinking, this year we have a merge, this year we have this year we have that. But you are still running some kind of a small risk of some bad like tail event hitting you. And what is like pretty interesting, right? That even if you are not a professional user, even if you're like not a pro, you can still use options, for example, to get a protection against events like this. So to give like very simplified example, right? When it comes to the options themselves, they like the instrument that if you purchase it, it's a little bit like insurance, right? You pay the premium. The premium is basically some kind of a price of this uncertainty. And once you buy the option, you have a right, but not the obligation, to enter into some transaction in the future. So, for example, let's say it's April. ETH was 3,200, and you think, if goes below 20, let's say 700, I will be very upset. Well, it's quite unlikely we'll say it, but I will be very upset. My wife will kill me. That will be very unpleasant. So what you can do? Well, you can sell everything now because you may not like the risk, but you don't want to sell now because you want to hold ETH, right? Because you never know what happens. Maybe we will see, this merge happening, and then ETH will go to some astronomical levels. So what you can do? You can partially offset this risk. So, for example, you can use options. You can use put options, and you can consider like making very like simplified moves, very simplified strategies. Where, for example, you can use the options as the insurance. So here, if you would buy options called put options, you will have a right to sell ETH at a predetermined price. So, for example, you will pay some small premium, and then you will have a right to sell your ETH at $2,700, to $2,700. And back then, this price was like, we'll not see this. Now, with ETH being at 1,700, hands up if you would like to sell your ETH today at 2,700, right? That would be very cool. And if you have bought the option, you will have this right, and you may like use the options for similar strategies. So as you will be getting more and more into the topic, right, you will for sure come up with more complex ideas, more expanded ideas. But even as a regular user in DeFi is very tricky because many things here are there is like a lot of complexity and risk like package, right, under fancy names and fancy tokens. So if you would like to carve out a portion of this risk, you can do this with options, for example.
Yeah, I think that's a great example. And also like looking at DAOs and like even treasury management, that's like if you had, a majority of holdings in ETH in your treasury and your runway, it's like you could have been looking at that and being like, okay, we need to, like, maybe we don't want to sell all of our ETH right now, but if ETH drops 30%, I can guarantee that we'll have, you know, the capital pay operations and whatnot just by buying, you know, spending like a percent on puts, right? So
this is a very great example because I can say that it hits home because we have been, for example, like talking to different DAOs, telling them, look, guys, if you, for example, keep all your treasury in ETH, you are, you know, running some risk that your runway may look much less stellar than it is now, right? It suddenly can be cut by 20, 30, 50%. So if like different DAOs, different treasuries would be, for example, purchasing some puts, then we would most likely avoid the situation that we have now, where you just, you know, you go to crypto Twitter and every day you see proposals where DAOs suddenly realize that, well, there is a bear market and we may run out of the funds, and they now consider selling ETH at the current price. So I think that's also interesting, like lesson for money, right? So most likely as DAOs will keep evolving, maybe, you know, we will see them headhunting some treasurers from like real world. So we may see, you know, more hedging, more risk management, and more stuff like this. But this is very interesting thing. Like if you run a DAO, you do not be, you know, a power trader as well, because in real life, you know, all those big treasuries, they usually just have some strategy, and they would, for example, like open some derivatives once a month to hedge everything, or once a quarter to hedge everything, and that's all. So sometimes it's like, you know, day of analysis and 1 hour of execution. So it doesn't take too much time, but it saves your ass. maybe to give the anecdote, that's like a TradFi anecdote, this is something overheard from like treasurers from all those, you know, big 500 Fortune companies. Whenever we talk to them, the guys are very, very conservative, because for them, they say, well, all those like instrument solutions, everything sounds very, very neat, but my risk number one is not getting fired. And in Fortune 500, the fastest way to get fired is to, you know, lose your company's money in a very fast way. So for this reason, all those guys are super, super conservative. So hopefully, you know, as we keep developing here, we may see and see the same here as well. So more planning, maybe more usage, but definitely many interesting things to come.
yeah, definitely, like DAO treasurers, it should not be like hedge fund managers trying to make prop trades and make money on options. Their goal is preservation of capital and kind of ensuring the runway of the team. So, but yeah, again, this is also where you can kind of, I think you can, there's a potential to automate, you know, the strategy that you want to pursue. It's like, you just want to hedge, like, you know, that X% downside, or you can spend this many dollars on that. This also applies to alts. So like, there's a big concept of protocol controlled liquidity, and, you know, if you can get deep enough options on that, then it's you can also on, you know, non-ETH, non BTC, there's going to be ways to hedge your own you know, protocol token as well. So
yeah, indeed, and I think what's also interesting, it's one of those pretty cool things in DeFi. Yeah, I think we can do a little bit of shilling here. I think, like, you know, the trick with DeFi, I have to say this, is like if you have been using or how to start. Maybe the best way to start would be, if you are and have been using various financial instruments in traditional finance, a lot of those things are kind of siloed, which means you would be able, for example, to do one thing with one counterparty, like brokerage, another thing with your bank, another thing with someone else, right? But they all these entities, they have, like, you know, separate databases. They may communicate with each other, but in a very, very limited scope. And what is interesting is like, if we are in DeFi, then suddenly we realize that we are all on the same chain, on the same database, which means if you run a dApp that does swapping, and for example, there is another dApp that does lending, then anyone can access the data like from all those on-chain dApps and allow for these dApps to communicate with each other, right? So suddenly you do not have the problems with with reporting, back offices, settlements, because everything is done by the blockchain. So this is what is also quite interesting. Is one of those kind of problems, for example, is like you might do one operation with like one entity, another operation with another entity, and if you would like to use different entities to create something complex, and you hope that if some event happens, the money will just flow to your bank account, then you are quite wrong, because all those settlements, all this may take days, weeks, maybe months. But in crypto, when you think about it, right, we are on the same chain. So technically, something that can be done is, well, you can, for example, use a leveraged protocol. You can use the perpetual protocol that allows you to mint stable coins, and you can merge those together with options. And this is what we are working in DAOPEX. That, for example, all your leveraged positions will be able to communicate with your option positions, which means that, basically speaking, once you will be in the liquidation zone or below, the protocol would communicate and they would say, look, don't worry, actually this guy has bought some options that they are like protecting the user from this tail event. So we do not have to liquidate him because he's actually solvent. So by doing like things like this, exploring things like this, suddenly, right, you can have some kind of applications that specialize right on one thing. So one does lending, one does swapping, one does leverage, one does options. But then you can build on top of them, and suddenly you can, like pick whatever you like and create very, very, very durable strategies that just work. And so exactly, like, stay tuned, because one of those things that we are working in DAOPEX are called Atlantic options, and pretty much this would be like options embedded into leveraged positions. So if you would, for example, open leveraged loan or trade on a leveraged protocol, and if you buy options, then suddenly you may be protected from liquidations. So you can just go to sleep with a leveraged position, because you will not get liquidated as long as your option position is open. So and I think there is like more and more to come, and I think like more and more to explore, because people seem to be having many very, very cool ideas. So I think even though we may be in a bear market looking at the price, I think when it comes to like ideas and things that people come up with, well, it's very, very. I wouldn't say it's bear market, because people. Maybe that's it. Like maybe all the devs do not need to respond to hundreds of DMs, so they now have time to build. But I think that this year is going to be actually very, very interesting when it comes to all the different innovation. And I guess we'll see what will work, what won't. But it's going to be nice, I guess.
I have a quick question, Jeff.
Hey.
Like I did some research on I see their strategy is to buy some puts to protect the downside. But when I look at the SSOV puts option, the volumes seems pretty thin, right? And also, like, even for weekly put, you probably has less than $1 million, and even that divided into 4 chances, right?
Yeah.
So there isn't much you can
Yes.
you really purchase up to $1 million, not less, even less than $1 million, probably 800,000 something, somewhere around that. That's the maximum puts you can
Yes.
you can have.
Yes, that's true. Can I say it's still it's still a very early stage with like trying to source liquidity and making sure that we have a sticky liquidity. But also the trick is this kind of a liquidity fragmentation. So we are exploring at which levels, at which terms we can find the most liquidity right now, and then based on this, we want to continue iterating. I think it's pretty interesting because in general, and I think this is a kind of I think downside of DeFi is DeFi is and was labeled as very democratized, which means anyone could have been able to be the liquidity provider. But for the same reason, it's quite visible. Like when you take a look across the whole DeFi, that TVL is quite significantly lower across all the protocols, and this is what we also observe on our side. But the thing is that we want to keep working on making sure it improves. And we also want to make sure that we can provide both. So once we have liquidity providers, we will be able to find another side of the transaction, and also once we have traders will be able to access liquidity.
Another question is there
on-chain liquidity fragmentation is definitely a thing, but it just takes time to get the users, to get the partnerships, protocols that may be regular buyers and sellers and market makers and whatnot. So
are there market makers for the options? I mean, let's say I believe it's all European options, right? So far, it's not there aren't any Americans.
Yes, so the market is mostly European, and when it comes to the market making, then in general, like the market right now, so if you are the larger institutions are mostly centered around the Rebit, and when it comes to the DeFi, it's quite interesting because in general we see that there is a skew toward liquidity providing, which means people are much more happy to LP for calls rather than puts, and for the same reason there is quite interesting problem or solution is how to make sure that we have very efficient utilization of liquidity. That trick is that if you work in traditional finance, you do not have to post all your collateral up front, right? Because if you owe some money, then you get a margin call which you need to deliver, and if you do not deliver, then you are getting sued. So there is always law which allows for the credit in DeFi. Protocols are unable right now to have any kind of credit, because we have no KYC, no onboarding. But also, if we are permissionless, we can't allow users to run on on shortfall, on a negative credit, because if someone would have a bad credit in DeFi, there is no chance they would repay this. So one of those kind of the pain points for now is indeed that in DeFi you have to fully collateralize your trades, but this is also something that we work on and keep working on, so that I think I got dropped. Can you hear me now, guys? Hello.
Yeah, you're back.
Yes.
Okay. Yeah. So I think it's one of those kind of interesting problems to solve, as to how to make sure, right, that collateral is being used in a fairly efficient way while not exposing the protocols and the liquidity providers to the shortfall risk. So there will be no bad debt. And I think this is, it's one of the biggest, most likely DeFi challenges, right? Because in in traditional markets, you have a very limited amount of bad debt, right? Because you have low and you have all the collection agencies. In DeFi, usually, right, if like a protocol is hacked or maybe there is some kind of Oracle attack, then usually once the protocol ends up with a bad debt, then usually it's over. So all the risk is usually on the protocol side. So that's why we have to tread very, very carefully while looking for the solutions. Yeah, I think that's I guess more or less all from our side. So feel free to shoot more questions if you have.
Yeah. Do we have any further questions for Jeff and Hako? Okay, so thank you, Jeff and Hako,
Thank you.
for the presentation and all the insights you guys have shared. So last but not least, I just want to give a quick update on Concentrator. And I mentioned about this product at the beginning of this meeting. So currently, Concentrator offers the highest yields on convex vaults by offering compounding services from convex CRV staking pool. And the Concentrator also plans to launch initial farm offering soon. It's a fair launch to distribute tokens to make Concentrator a community-owned and a community-run protocol. And it's also the first time ever fundraised by taking farming yields. So we also have a community contributor program, and it's an open program to attract the contributors to help us to educate the community on Concentrator and also the initial farm offer. So you can find more details from Concentrator Twitter account and Discord about everything of the product and the initial farm offer. And please feel free to pin us, come to the Discord, ask any questions you have, and if you would like to contribute. And I think that's the end of the hour. That's the end of the meeting for today. And thank you, everybody, for your time.
Thank you.
Okay.
Yes.
Thank you, guys.
Thank
Okay.
you.
Bye.
Thanks, everyone.
Thank you, everyone.
Thank you.
Thanks, guys. Bye.